financing techniques to pass your real estate exam. Okay, so this section here, we're going to be talking about finance techniques to pass your real estate exam, and it would be included under the financing the real estate transaction if you have a book and you're following through. So financing techniques, because we talked about the last section, we talked about the different types of financing, right? Give me one of the different types of financing. FHA. How much you need down for FHA? 3.5%. Give me another type of financing. Conventional. How much do you need down for conventional? Down payment.
20%.
20%. Give me another type of financing. VA. How much do you need down? Not, if qualifying veteran may not need nothing down. And then what was the fourth type of financing? And what was that called?
Farmers.com.
No.
Farm credit?
No. No.
Farm service agency.
Agricultural loan programs, Farm Service Agency, Farm Credit, and Farmer Mac buys those loans and then pulls them up and sells them on the secondary market. So now we talked about all the different types of loans. Now let's talk about the techniques to finance them. And you have amortized loans, okay? And if you go into the book, there's that amortized schedule to figure out the PIT, the principal and interest payment, right? That would be an amortized loan. An amortized loan is a loan where the principal and the interest are payable in monthly or other periodic payments, but the interest rate never changes. Then there's an adjustable rate loan, mortgage. They call them ARMs, okay? Generally, it's originated at one rate of interest that fluctuates up and down. The loan is typically based on some type of index. So if the index goes up, the interest payment goes up. If the index goes down, the payment goes down. Okay? So just remember, an adjustable rate mortgage is mostly based on some type of index. The balloon payment loan or a balloon loan, okay? A balloon loan. It's when you make periodic payments, but the payments are not large enough to fully amortize the loan. And by the time the final payment is due, there's still a balance. So the final payment is larger than the others. So I bought a property off of a guy. He was a doctor. And we had a balloon loan on it. Now, he financed it. He financed it. What type of financing we call that when the owner finances it? No. The owner that is financing. Remember, there was a vendee and a vendor. What type of financing was that? Look at the book. It wasn't that long ago we talked about it.
No.
I think it was the same chapter.
I thought I had it.
What kind of financing is it called if the owner himself finances it? Nope.
Start with no.
Oh, deed of trust.
Nope. Could be, but I'm looking for installment land contract, or what's the other? What else could it be called? Is it a deed of trust? Was I too quick to say no? Installment land contract is one form of owner financing.
Oh, is it hypothecation?
What is it?
Is it hypothecation? The borrower is required to pledge specific real property as security for the loan. The debtor retains the right of possession and control, while the creditor
let's look at the back under vendor or vendee.
Installment contract.
Is it an installment loan?
That's what the land contract.
Yes, installment loan or a land contract would be considered owner financing, right? So I bought a property, owner financing under an installment land contract, but we did an installment loan. What page is it on?
Oh crap, it's gonna be different for me, but it's on unit
Let's look in the back.
18, sales contracts. It's at the very end, right above the key review. Under installment contracts. And the only reason I know that is because I wrote it real big on the side. I put forms of owner financing, land contracts, contract for deed, articles for agreement.
Contract for deed, I think, is the word I was looking for. Okay, so it was a contract for deed, an installment, the difference
It's
between,
like a car loan.
well, the contract for deed, you would convey the deed to the buyer, and then you would just hold the mortgage as the vendor, okay? An installment land contract, the property would stay in your name, and then once the buyer pays it off, then the deed would be conveyed. So this guy did what's it called? Contract to deed?
Installment.
Installment.
Yeah, installment contracts.
And he did an installment contract, not a land contract, because he wanted the property out of his name. He didn't want to be liable. And I gave him 20% down, and we had a 10-year loan with a balloon payment at the end. Okay, so at the end of that 10 years, I think I paid like $150 for the building. I still owed $70,000. So I either had to sell it before the balloon period and pay it off, or I had to refinance it. So the balloon payment is done quite often, especially with owner financing, because the guy didn't want to hold the note for 30 years. But I like the fact, when I used to buy and sell a lot of properties, I like the fact that if I did something owner financing, it wasn't a ding on my credit report. Because typically the owner doesn't go to the credit bureau agency and say, Simon got a loan, he owes me $150,000. It's not on my credit report. So I used to like to do that a lot. So balloon payments vary with creative financing, commercial loans, where you make a payment for so many years, and then bam, you got a balloon payment. At the end, you got to pay it off. Okay, if you don't,
Commercial loans,
commercial loans, very, very common with commercial loans.
but you could use it on residential.
You could use it on a residential loan. Yep. So just remember a balloon payment, Lex. You're making payments, but at the end of the loan term, you didn't make enough payments to pay it off. So there's going to be a larger balance due on your last payment. Okay. A growing equity loan. This is also known as a rapid payoff mortgage. When the borrower negotiates a growing equity loan, they know the monthly payment will increase. However, the payment increase will be applied directly to the principal. This is reducing the term of the loan. So a growing equity is just like the term. A balloon payment, a balloon is a big, when you have a balloon and it's on a string, imagine the string is your monthly payments, and then at the end of the string, you have the balloon. It's a bigger payment. The balloon's bigger than the string, right? So at the end of the payment period, you got a bigger payment to help you with balloon payments. A growing equity loan is just like the name it says. Growing equity, you're going to build more equity in it. So the growing equity loan, your payment would increase with the additional going towards the principal. And that reduces the term of the loan. Then there's a reverse mortgage, okay? And this is for people 62 or older to borrow money against the equity in their home. And it's opposite of a conventional loan. Because a conventional loan or an FHA loan or a VA loan, at the end of the term of the loan, you owe nothing, right? A reverse mortgage is just the opposite. So if I went and got a reverse mortgage, let's say my house was paid off. Let's say my house was worth $100,000. And I went and got a reverse mortgage. Lex, they'll give you the $100,000, you don't have to make any payments and you can still live in the house. And then when you die, the house has to be paid off. Or they'll give you the $100,000 and you can make payments against that, but you already have the $100,000. So a reverse, but it's only for people 62 or older.
So you essentially get they pay you your mortgage payment back.
They're giving you can pull the equity out of the house, is what you're doing. So maybe maybe you're 62 and you ain't got enough money to get by on a day-to-day basis, but you have a house that has equity in it. You can pull that equity out, still live in the house, and then when your no payment is due until the property is sold or the borrower defaults, moves, or dies. So you don't even have to make payments on it. So if I want to get a reverse equity loan right now, Lex, whatever equity I have in the house, I can get a reverse mortgage. They would give me the money, and when I died, moved, or defaulted, whatever, then it would be paid off.
The bank would then pay.
And then they can take the house and sell it if you don't.
So you
Okay.
couldn't will that.
What's that?
You couldn't will your house if you did that.
Well, no, because you could will it, but they would be you could will it.
They would assume that.
But if you owe more than the house is worth, you're messed up. Like there was a house on Vernon Drive. Older guy had the house. He got a reverse mortgage on it, and he never did anything to it. He just let it get into repair. Well, when he passed away, he owed more on the house than it was worth. So the bank came in and took the house and sold it.
Let me ask you this. Say the house gets willed to a child.
Oh man, you're getting it. Don't worry about that. It's not going to be on a test.
Okay.
I can tell you already. You don't worry about
Today we're going to answer the question, how does a reverse mortgage work? So here we go. First, the lender has to determine the loan amount. They'll use a formula set out by FHA that takes into account the value of the home, the age of the borrowers, and rates to determine the loan amount. Usually it's between 40 and 60% of the home value, depending on your age. Once they know what you qualify for, then they'll want to know how you want to take your money. The closing costs of the loan will be rolled into the loan itself. This means you'll have a starting balance equal to those costs plus any other funds you decide to take at closing. Perhaps you have your home paid off and don't need to have all of the loan money right now. You could choose to take your loan proceeds in the form of tenure, which is a monthly payment for as long as you live in the home. In this scenario, on the first of every month, you will receive tax-free funds from the lender. Each month, you would also receive a mortgage statement. It'll show you the prior month's loan balance, the amount of payment to you, the amount of interest and insurance charged, and the new loan balance. Or perhaps you'd like to have all of your loan funds ready and available as you need them in a line of credit. In this scenario, you would receive a statement each month from the lender showing the existing loan balance and the amount of funds previously available in the line of credit. The statement would also show any withdrawals you made from the line of credit the prior month and the new available line of credit. One of the coolest features of this particular scenario is that the line of credit on the reverse mortgage grows over time. The amount available to you in the line of credit grows at a rate equal to the rate charged on the loan itself plus 1.25%. So reverse mortgage line of credit in the amount of $100,000 today would be over $104,000 next year. It's a great incentive to limit your withdrawals, building up that line of credit over time so that when you're 70, 80, or 90 and really need money for home health care or other emergencies, you have more to draw from. Another scenario would be to take all your money right now to make a major purchase like a second residence or investment property. The last and most popular scenario is to combine those different payout options, perhaps taking some funds at closing to pay off other debts and leaving the rest in a line of credit. It's your choice. I've had clients who choose some cash, some line of credit, and a 10-year payment as well. It's up to you. If you currently have a traditional or forward mortgage, you can use the reverse mortgage to pay it off. In fact, it's required by the lenders that any existing mortgage on the properties must be paid off with the reverse loan proceeds. The reverse has to be the only loan on the property. Now, you know the bank's going to make money on this reverse mortgage, right? They're a bank, and that's what they do. I mean, really, they're in those big, tall buildings downtown, and they're happy to make money off of us. Millions living in our sweet little homes. Basically, the banks and investors are just patient. They wait. They wait until you die, sell, or permanently leave the home due to medical reasons. Then all the funds that have been borrowed, plus all the accrued interest and insurance, is due and payable. Usually the heirs will sell the home, pay off the reverse, and keep the change. But if the home does
That's your
not have
answer.
enough value to pay off the balance, then what? This part's pretty cool. The reverse mortgage is a non-recourse loan. This means if the proceeds from the sale of the home are not sufficient to pay off the mortgage, the bank has no recourse to the borrower or their heirs for the shortfall. So the worst that can happen is your kids get nothing from the home. and pass away.
Nothing, Liz.
Well, that took a little longer than I thought. Thanks for sticking with me. I hope you found it to be helpful.
You understand
I'd appreciate
reverse
you
mortgage
leaving a
now?
comment or any other questions you might have in the comment section.
It's a way of pulling money out, and you don't have to pay it back unless you die, go into a nursing home, or sell. Now, they want to make sure they're the only mortgage, right? So you have to pay the other loans off, because why?
They want to be number one.
They want to be, that's right, they want to be number one. And if you don't have enough money, if the house isn't worth what they lent you, it's a no recourse loan, they can't come after you or your heirs. Like, let's say you left, went to a nursing home, and they can't get enough money to sell to satisfy the loan. They can't come after you and say you owe us more. So reverse mortgage is very popular with people over 62 that need money to live, but they have a lot of money of equity in their home, and they want to still live in their home.
Bush has got commercial pretty hard.
It's somebody on the, yeah, I see him on there. Purchase money mortgage. That's what I was looking for with a land contract. A purchase money mortgage, the seller agrees to finance to the buyer. So that's another financing technique. Package loans include real estate and personal property. Very common down south. Miami, you buy a condo, you're going to get maybe a package loan because not only are you getting a condo, but you're getting all the furniture in it. So no, in a package loan, Lex, you're getting not only the real estate, but the personal property too. You're financing them all. A blanket loan. A blanket covers more than one person if you're in bed with somebody, right? It can cover more than one property if you get a blanket mortgage. So you may go to a lender and say, hey, I need to borrow some money. I have 3 rental properties, and they may do a blanket mortgage and put a lien on all 3 of them and lend you the money. Wraparound loan enables a borrower with an existing loan to obtain additional financing with a second lender without paying the first loan off. So somebody asked me a question, could you borrow for the down payment? It's against the law to borrow for the down payment, but you can have a loan on your house and you can get a wraparound loan without paying the first one off if you need to pull money out. And a home equity loan, everybody knows what that is. It's a way of pulling equity out of your house. There's open-ended loans. These are less costly alternative to home improvement loans. It allows the borrower to open the mortgage to increase the debt to the original amount or stated amount. There's construction loans, generally short-term. Charleroi Federal does construction loans. When Nina and myself were going to build a house, we went to Charleroi Federal. We were going to get a construction loan. When we went to Charleroi Federal, they said, okay, you get all the bids, we'll give you the loan. And typically the loan is good for a short period of time, Jace, because once the house is completed, then you need to convert that to a regular mortgage. So a construction loan is usually for a short period, most of the time while you're building the home. Okay. Probably a little higher interest rate. And then when the house is complete, you refinance it and get a regular mortgage to pay the construction loan off. Sell and leaseback. Gabriel Brothers use this. Used for large commercial properties.
Like a gas station.
No, sell and lease back would be, let's say I wanted to sell my office.
Okay.
But I still wanted to run my business out there. So let's say I needed some money. I may sell my office and do a sale with the lease back, and the person that buys it, I just make him lease payments. Become his tenant. And buy downs is a way to lower the rate on a loan. Buy downs, you use discount points most of the time.
Woo,
We're almost done.
that was it. Unless you got more slides.
So let's look at some math. Here's an example. Is this example in your book? No. Let's hold off on the math then. This was the calculation that we used. I'm going to use this. So let's say that, I'm not happy with that. We're going to hold off on that math. What type of loan is the lender likely to charge a lower interest rate? 15-year fixed rate, 30-year fixed rate, a construction loan, or a jumbo loan? Who's going to get the better interest rate? What, right?
Be the 30-year,
No. Remember, the longer the loan, the more the what?
the more the rate, the lesser the loan, less
No, the more risk.
risk. Level.
Because something could happen to me in 30 years, better chance of me getting through 15. So a 15-year loan, they'll give you a better rate. A 30-year loan, you're not going to get as good a rate. Construction loan, remember I told you they're short-term, usually higher rates. And a jumbo loan, remember I told you they won't even buy those on the secondary market. Usually you're going to pay a higher rate for a jumbo loan. Which of the following is required for a veteran to receive a VA loan? Anybody got the answer? What do you have? D? Yes. A certificate of reasonable value. Isn't that just like an appraisal? Yes. But it's the VA's terminology for doing it. Okay, so that's going to end this section. Andrea, you can knock this bad boy out. So we